Hi everybody and welcome back to Accounting 482. This is session 24 and I want to go back to the income statement one more time because we forgot the double underline. I know. I can't believe I did that because this is done and we always get a double underline when we are done. So hopefully some of you said, hey, we're not done, but I didn't hear you, so I had to go back and double check, and there it is. Now we are going to do the pro forma balance sheet. And I've made mine bigger, of course. I didn't do that for one class. Oh, I've got to take my phone and put it on silent. I'm sure I'll get something. I never do until I'm taping. Okay, so we are on the pro forma balance sheet. And we're going to get started right away because we've got all of our numbers that we need in our other budgets and we can just get going. So first thing we want to do is take and merge and center A through F. Right here, we're going to do a merge and center, and we're going to bold this, and we're going to type assets. Now, the income or the balance sheet will have our current assets and our property, plant, and equipment, and then that is what we own, okay? And then it will have our how we paid for it, either with a liability, which is money we owe, or our owner's equity. And it's stockholders' equity because this is a private or a public company. Private companies would be your owner's equity. So this is a snapshot of the company in time at usually at the end of the year or at the end of a fiscal year. Some companies don't use the calendar year as their year. I know that usually retail uses September 30th as their fiscal year because they want to capture all of the sales for the holiday and then the returns, and so it all evens out by the time September rolls around, and that gives them a good idea of what they did for the whole year. And other companies and industries do the same thing. Usually, if a whole industry uses a particular fiscal year, all of the companies in that sector, and a sector is a type of business. So all the retail stores are a sector, and so all the lumber companies are a sector, the lumber sector. So they usually all use the same fiscal year so that their financial statements are all comparable to one another, because that's what we want. We want comparability and transparency so that we can easily, well, analysts can easily compare two different companies in the same sector because their financial statements are all computed or put together using GAAP, and that way everything is comparable, transparent, and that's what we really want. We want these to be transferable and transparent and comparable. And I just combined that word and just said transferable. That's a good one. I don't think they're going to let me use it though. Okay, so we're going to start here with current assets. And our first current asset is our cash. And now these are listed, believe it or not, in a certain way. They're listed by how fast you can convert them to cash. So cash is cash, so it's always listed first. And accounts receivable is second because we assume that we're going to be paid for those accounts in cash. I know. When I finally realized that, I learned it in Accounting 201, but it took me a while to really get that, and I think that's interesting. So we want to link this to the cash budget, and it is the ending cash balance. The ending cash balance for year one is the total that we're going to use, and it is right here. Now, another thing that we're going to do is we are going to link all of these numbers, I'm going to center that and I'm going to pull that all the way down. No, not that way. I needed to use a format painter. So that's all in the middle, all the way down. Okay, so over here on the next side, I'm going to, right where I have assets, right in this line, from H to O, I'm going to merge and center and bold our notes to the balance sheet. And what I'm going to do here is I'm going to type and let you know how we're going to get these. So I moved this over to H, if you saw that. I moved it over to H because I always use too much room. And what we'll do is right here, I'm going to link that A, and I'm going to type in here where that number is coming from so that you can go back later and understand how these numbers, where these numbers are coming from, so that when you do your budget project, you'll have this to use as a guide on how to put that one together. So this is shown as the ending balance of the cash budget. Okay, and we'll do that for each number so that you can easily link these and figure out where they came from. So our next account is accounts receivable. That's another one I usually type wrong. And this one is going to be B. I'm going to see if I can just type B. Will it do it? No, it will not. Well, I thought I format painted all that. Oh, we'll try it again. There we go. We'll try that. And then here, I'm going to skip a line so that it's easier. And we can just link that B so that it matches. And now this one are now this is a chart, so we can't just pull that one out. The amounts from M, from the sales budget, and I should really capitalize those. Sales budget that have not been collected. So we need to make a chart, and right here we will type quarter. I'm just going to tab it over. Sold, collected, and what's in accounts receivable. And AR is a typical abbreviation of accounts receivable. And then I'm going to underline all those with just a bottom border, not a double. We're not done. And then we're going to do quarter 3, and then I'll just follow that down because my Excel budget knows that I am working in 4 quarters, so it'll do that for me. So now we want to figure out what we have not collected yet. So we'll need to go to our sales budget, and I'm going to link this. We want to figure out what we sold in quarter 3. So back to the sales budget, quarter 3 is right here, and our sales revenue is $1,980,000 total sales revenue for quarter 3. And I want to format this properly. Okay, and then we want to format paint that. Okay, good. Now we want to link what was collected, and that is also on the sales budget, but it is down here for quarter 3 we collected that much. Okay? See where I'm getting that number? And then we're going to do the same thing for quarter 4. We're going to get the sales budget for quarter 4. We sold 2.45 million. Link that in. And then we're going to link in what we have collected, because we don't have what we have not collected, but we do have what we have collected, so we can figure that out. And our collections for quarter 4 is this number here. And now here we're going to figure out what we have not collected yet. The sold amount minus the collected amount is going to give us our accounts receivable. And I'm just going to, I just copied that formula down. And now we're going to, I just underlined that right here. I'm going to bold it, do accounts receivable. See, I always misspell that. Okay. And then I'm going to justify that. And then I'm going to add these together with an auto sum. And now this here, this $1,119,100 is now my accounts receivable. Just going to link that over. Okay. And we can bold the number 2 because that's what we used. Now our third item is raw materials inventory. And this is C. Hopefully, oh, look at it, it's going to work. Nice. And I can take this and link it to my C. Oh, look at that. Now I know there's a way to do it. I think we do. No. Well, that's just going to have to be there and I'll figure it out. I know how to do it. That's why he has the period. He has a period after every one, and that's probably why. Like A with a period. And I didn't do that, so that's probably why. But we've got this fixed, or you could use the copyright copyright symbol. It works. We know what we're doing. And then our raw materials inventory is shown in the cost of goods sold calculation in the notes to the income statement. So we have already calculated that, so it is on the income statement in the notes, and our raw inventory is our cost of goods sold. Is our ending raw materials inventory. And then the next item is our finished goods inventory. And this is D. And we will link that. And now this is shown as the cost of goods sold. Nope, reading the wrong one. Shown as the ending balance of the ending inventory budget. And that is the ending inventory budget right here. And that is our total ending inventory budget right there, finished goods inventory. Now this we're going to do the double the underline for the two columns, and we're going to sum those. Is that going to work? No, that did not work. Okay. Okay. So this is a wrong number. What? How can that be a wrong number? That is the most bizarre thing ever. I've got everything up there. It's correct, and then it gave me a wrong number. There we go. I think it's because I had included that cell. Apparently there's something weird going on in that cell, but anyway, 1,595,620 is our current assets. Now we need to title that total current assets. And now we will have property, comma, plant and equipment, which is also called PP&E. Oops. PP&E. And in here we will have land. And where are we going to get this? I'll tell you. This is E. Hopefully it... I'll see. That gives us a... it's an equation. Simple. We're going to have to use the E period here. So I won't do that. That is a pretty cool symbol. In fact, I used it in my lecture earlier, and I just cannot think of the name. Shoot. I remember it, but not right now. Okay. So this is going to be found, shown on the balance sheet. Balance sheet from the previous year. No additional purchases or sales. Because we couldn't use this number if there were additional purchases or sales. We would have to do some math like this. So go to our basic information page. Here is our balance sheet from last year. And there's our land. We're just going to copy that over. And now building. Building. And this is F. And we're going to link that over. And this is also shown. In fact, watch this. I know. Handy, right? Did you see what I did? I just copied that whole thing. I just clicked my equal and I made the formula, that sentence. And it just popped right in. Now, we're going to go back to our basic information sheet and we're going to pull that. And we got a hashtag party. I just double clicked to make it as big as I needed it. Or you can move it manually. Sometimes if you're working in a very long spreadsheet and you've got something up above that you're trying to hide, you're hiding it, and you click that and it makes the cell huge, it messes everything up. So, depending on what you need, both of those options are great. So now we have equipment. But we cannot use we can't just use the old number from the from last year because we added some purchases this year. I'm going to move this up. So it's the equipment owned in previous year plus additional purchases made in the current year. Or they could be sales. But right now we have purchases, so that's what we'll go with. This is the previous year. Previous year. And then Q1. And then I can just go like that, because it knows me. It's like, oh yes, that's what you want. Okay, so we want to bold this, and we want to underline that, and then we want to center it so that it looks really good. And we're doing this so that you can become more familiar with Excel and get better at it. Also, we want this really organized so that you can use it when you're doing your budget project. So now here we want to link this to the basic information page, the 1.5 million. And then our purchases can be found on our cash budget. But we need to make this a negative because on our cash budget, these purchases are negative, these equipment purchases, and we want them to be a positive. So we need to subtract this negative to make it a positive, and then we can just drag it across all the way to Q4. And it's going to pull all of those. And now we just need to total them up. We can do the auto sum. And this will be our total equipment for this year. So we just want to link that in. Okay. And now we have accumulated depreciation. Now, accumulated depreciation, if you have forgotten, and this is going to be for building and equipment. Accumulated depreciation is when you buy an asset, say, land is not a depreciation, by the way. When you buy, say, a piece of equipment and they don't let you expense that entire amount in 1 year, they allow you to expense portions of it equally over its useful life. And we do this because you can skew your net income if you have too many expenses. Okay. Imagine if you had a bad year and you bought a piece of equipment and you expense that whole thing, and what you do is you end up with a very large loss. And that loss, I know this is going into taxes, but that very large loss can be spread out over 20 years. And then you can, you take that loss for year over 20 years. And what it does is it brings your net income down to zero because you have this net income and then this loss, and you can bring it down to zero and not pay any taxes. So that's why they make you do depreciation over over the length of the asset, the useful life of the asset. Now, in the new tax laws, I think they're letting you expense all of those assets the first year. And what that does is it creates a lot of companies going out and purchasing large items. So it is it's a way to help the economy do better, but then the ramifications for the taxes going forward are bad because then companies aren't paying taxes. So there's my spiel. I don't agree with it, by the way, but I am not a lawmaker, so. Okay, so depreciation is going to be our H. And we're going to link that down here. And our depreciation is the accumulated depreciation. I'll just go like that. Depreciation in previous years plus any additional. Plus any additional. Plus depreciation. I've got this down too low, so I'm reading the bottom of the page. Kind of making me crazy. Okay, depreciation in the current year. And this was shown in the manufacturing I got a manufacturing overhead budget. Okay, so we need to, it just went away. I think it'll come back. Quarter and purchased. No. Previous year. This is one of the hardest budgets, so I apologize for that. And then we're going to do Q1 and go across and center that, and we'll get a total. Okay. And we want to underline that. So the previous year, it's going to come off of our basic information page because they have accumulated depreciation, right? And we will need this, just leave it that negative. And then the rest of this is going to come off of our cash budget. I'm sorry, S&A budget, because it is not cash. Nope, overhead budget. That's what I said, right? Overhead budget. It is not cash, and this is the depreciation. And then we're just going to carry that over. So each quarter, we get to take off $15,625 in expenses, depreciation expense for the equipment. And now we can just do an auto sum. And now this can be linked in right here. And we will link it in as a negative because it technically is. It's coming off. So now we've got total. We'll have our total property, plant, and equipment. PP&E. And it'll go right here. Let's do our underline there so that it's all good to go. And then we're going to take that, add it to that, add it to that, and add it to that. So now our new property, plant, and equipment is $2,488,000. Now this is our two components. We've got total assets is going to be, I'm going to do this line right here. It's going to be our current assets added to our PP&E, and we're going to get this beautiful number. This is what we're looking for. Top line and bottom line. I shouldn't do that yet. Let's pull that off and just go with the bottom border there, because we don't know if it's going to match, right? This is what we got, but it's a balance sheet. This has to equal our liabilities and stockholders' equity, or we can't double line it. So now I am going to take A through G, and I'm going to merge in center, and I'm going to bold it. Did it go all the way to? No, I didn't. It'll be fine. Liabilities. And stockholders' equity. Okay. And the first thing we need to list is current liabilities. Move that up so we can see. And I'll move this up so I can see. And our accounts payable. And this is going to be our I. And we're going to link that down here for our I. And now this is the amounts from the direct material budget that have not yet been paid. So this is what we owe, okay? And right here we're going to have another chart. Quarter, in fact, we could technically copy and paste that, but I'm right here. Purchased no S right there, delete that. And paid. And then you'll get your accounts payable, which is that. And of course I want to underline it, and I want to center it. And then here we're going to do our Q3, because we don't owe anything after that. And it came up with me. And we're going to do the same thing. We're going to go over to the direct materials budget down here on our schedule of cash payments. First of all, we purchased in Q3 $988,986, and we're going to pop that in. And we paid, let's go over to pay. Nope, direct labor. Okay. We paid in Q3 $988,986. Of course, that one is not formatted. I'm going to use my format painter, and I'm going to cover all that so it's the same. And now in Q4, you can see that we paid everything there because our payment schedule is different for our direct materials. In Q4, we bought $1,073,281, and we paid only $804,960. And now here we're going to take our purchased amount and we're going to subtract our paid amount, and then we are going to get our accounts payable amount. So underline that, and right here we're going to write justify, and we're going to have our accounts payable. And we should bold that because that's the number we're going to use in our budget. And we can do an auto sum there. And bold that. And we can link that right here. Okay. Now our interest payable is our J. Okay, and link our J over there. And this is the difference between interest expense from the income statement and interest paid, which is the cash budget. So we will have our interest expense and our interest paid and our interest payable. I'm going to just move this K just a tiny bit so we can see that. And I want to underline those to keep it nice and nice. So here's our line of credit. We had two kinds, right? We had the line of credit. Line of credit. And then we also had our bond payment, okay? Bond payable, okay. Now our interest expense is coming off of our income statement. So that's where we go. And our interest expense right here. And the bond payable, we can just pull that down and it'll bring that down. Interest paid is coming off of our cash budget. Okay. Interest paid, we paid all of that, right? And we want this to be a negative. I snuck in there. Did I get the right place? Yeah. Because that's a negative number and I want it to, oh, I did not like that one. No. Okay. So we'll just go to the cash budget. It doesn't like it when you think about what you're doing, right? And this is also going to be a negative number. I lied. I did lie. Let's go back and delete that. Wow. When I make a mistake on here, I really make a mistake. Okay. This is going to come off of our cash budget. And we're just going to link it in because it's a negative. And our bond payable interest from the cash budget is going to be our $50,000. And then here we're just going to take that amount and add it to the interest paid. And then we're going to do the same thing there. And then we're going to underline that. You guys are probably already ahead of me right now. And right, justify, and we're going to do bold. Interest payable. Oh, I thought I right justified that. It must have not liked me. Okay. And it took that off too, huh? Wow. And we can do an auto sum here. And we do that because if you have, when we change our budget, we want all of those links proper so that this stays true. And it changes with any changes that we make. So we want to have that linked. We want to do it right. So now we are on our income tax payable, and our current liabilities again are any liabilities that are going to be paid within a year. Typically sooner, but we want to, keep that. Think of a current liabilities, anything that's going to be paid in a year, and then our long-term liabilities are anything that is going beyond a year. So our income taxes payable is our K, and we're going to figure that out, right? Although I don't think we have anything to figure out. We do. And it is the difference. I was just thinking we had, um, the interest expense on our income statement, but no, we prepaid some, right? The interest between the income tax expense I had to make sure I wasn't making a silent movie. Boy, that's just depressing. Oh, it's a silent movie. From the income statement and the income tax paid. In the cash budget. Okay. So we have income tax expense. And that is coming off of our income statement. We've got it right here. Of course, that one needs to be negative, of course, because we want that to be a positive number. Okay, and then the income tax paid. And that one is coming up on our cash budget. Let's see, cash budget. Income tax paid right there. We'll leave that a negative number because we paid it. The expense is not paid. The income tax paid is cash. And so we will have right, justifies what I was looking for in bold. Wow. Income tax payable is the difference. This plus this. And we can bold that. And that is our number. So we can just link that in. Okay, and now this will be, I believe, yep, total current liabilities. And we need to do our long line, and then we can add these three. Total current liabilities, that's my number. Perfect. Now we have long-term liabilities, and these include your bonds and all that good jazz. So the first thing we have is bonds payable. And this bond was a multi-year bond, so that's why we have that. And this is our L. And we're going to put it down here, link that over. I know, I have to move this now. This is shown on the balance sheet. No previous additions. So you know what? I'm going to go up and we're going to link that down. No additional purchases or sales of that bond. So we can just link that from down here, bonds payable. Now here you might ask why these accounts payable didn't come into the equation. If it's a current liability, it will have been paid before we did our second year balance sheet. Okay, but I'm sure that if you saw that and we had questions, it's already been paid, so we just take at the end of the year those numbers. Okay, and now the next thing we have is the line of credit payable. And remember that we did pay all that off, but we want to put it here so that if we change our stuff, everything will be linked and we'll be good to go. Then this is the difference between credit drawn, withdrawn, I should say, withdrawn, and payments made. Okay. So we have credit withdrawn. I do not know why I have such a hard time typing that word. Okay, so we withdrew that from the cash budget. The amount withdrawn is right there. Okay, current loans, drawn amount. And then we have payments made. And that will also be on the cash budget. Payments made right here. Principal. Because the interest is in a separate section, right? And then right here we can have line of credit payable. And we're going to do the same thing here. We're going to write justify and we're going to bold it. Line of credit payable. And we will underline that. And we will auto sum. And then we will link that in here. And then the next one, we're almost done. Almost done. This is everything we have for our total long-term liabilities. So we can't, whoops, no. I just want to get a line in there and it was being difficult. Add these together. Okay. Oh yes, we have to bold that. And now right here we can do total liabilities. We can underline that and we want to add these two together. And now we want to do stockholders' equity. And the first thing we want is the common stocks. We are almost done here. Common stock. And this is 100,000 shares outstanding. Do you remember putting that in the 201 class? We use it. we use it. And this is our N. Okay. N. And that is shown on the balance sheet from the previous year. No payments. Payments main or additional shares sold. I'll just say no stocks bought or additional shares sold because sometimes you buy back your stock, right? So we're just going to link that to our basic information page. And it's right there, 1.75 million. And then our retained earnings. And this is another calculation. Okay. And this is going to take us back to that again. And so it's the previous balance, which is shown on the balance sheet from the prior year. Plus current earnings less dividends. Okay, so retained earnings from prior year, and that's going to be on the balance sheet. Retained earnings right there. Okay. And this is plus net income. I don't know why that one's really big. Huh. Interesting. We made it normal. And the net income is on our pro forma income statement right here. Okay. Net income. And we want to do some format painting. Boop, there we go. And then we want to less dividends paid. And this will be found on our cash budget. Okay, cash dividend payments right there. And we can make this red, so we're going to have to do this format painting and put that there. Okay, done. And then this will be our, let's make it bold, retained earnings at the end of the year. And let's just try to get out of there. And we want to auto sum that. And that's going to give us our retained earnings. We'll bold it. And then we want to link that in here. Okay, that is our last computation. I know. And so now we have our total stockholders' equity. Oh, we have to move these over. I know. Our little underline, and so that we can add these up. Perfect. And now we have total liabilities and stockholders' equity. And we want to add total liabilities plus our stockholders' equity. And if, oh my gosh, look at that. Oh my gosh, we are good to go here. We can now do the top line and the double line because we have now created our balance sheet with our assets and stockholders, liabilities and stockholders' equity, with all of the notes that you need to do another one of these on your budget project. This is everything you need right here. So I'm going to save that because I don't want to lose it. And I'm going to end this session here because it's a long one, I think. And then we will come back next time and do the statement of cash flows. And then we will have created and made a complete master budget, complete with the pro forma financials. And that is amazing. It's an amazing tool. Even though it requires a lot of work, it's an amazing tool. So I'm going to end it here and we'll see you next time. Thank you.